Hello, and welcome to Portfolio Matters, week 120. We've done a lot of these now. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. What do we have this week, Keith?
Well, we have a packed program this week. There's been a lot of data. So, first of all, the news. Well, the US has passed a debt ceiling bill, and that has led to a surge in equity prices around the world on optimism. But remember that when the debt ceiling has been passed, the US will now need to refill government coffers by issuing a lot of T-bills, and that will refill the TGA account and drain financial liquidity from the system. And if the relationship between financial liquidity and the stock market holds, that should be bad for the S&P 500 over the coming weeks/months. We had US JOLTs job opening numbers for April in the US this week, and those were unexpectedly high. They rose when the market was expecting them to fall. And separately, Fed officials are now saying that they would prefer to skip a rate rise in June, and the market is pricing in only a 25% chance of a rate hike in June, although it's expecting further rate rises later in the year. But those expectations are very volatile and seem to change day by day depending on the economic data. We had US ADP employment change data for May, and that also beat expectations. The US jobs market remains tight. We will go through that in due course. The jobs numbers are out today, non-farm payrolls, and frankly, I expect them to follow the ADP numbers and be better than expected. US PCE inflation numbers came out and they were worse than expected at 4.4%. Now, quickly going through the proposed debt ceiling bill, please pause and take a look. The bottom line is that it restrains discretionary spending, ex-military, Social Security, and Medicare. It does not really cut US government expenditure, and it is not expected to lead to a slowdown in the economy, in the US economy, or a recession.
I was listening to a webcast this morning, Keith, and the guy on it was saying that there is a little sneaky clause in it which says that the controller, I can't remember the correct title, who has final discretionary say on whether a program will be funded or not. In other words, there's a clause in the bill that takes it out of the control of Congress.
Wow. Interesting.
Yeah. In other words, it's not really a debt ceiling.
If the US goes into recession, you'd expect Social Security payments to go up, and those are excluded from the bill. So this would not stop counter-cyclical fiscal policy, which is a good thing. But still, the US fiscal deficit is absurdly high for this stage in the cycle.
And there is nothing in this which stops it from continuing to grow at this exponential rate that's been growing out for the last 20 to 30 years.
Yeah. So some charts related to the news. Well, the S&P 500 rallied on the optimism, although frankly, that is all due to tech companies.
Yeah. So again, the same webcast. That's quite interesting. And he said that actually the S&P 500 has rallied 10% this year. The S&P 493 rallied by 1%.
Yes, absolutely. And the Dow is flat.
Yeah.
Now, reminder that there is a very strong correlation between the S&P 500 and financial liquidity. And as the US government now refills the TGA account by issuing lots of T-bills, it will be draining liquidity, and that should be bad for the stock market if that relationship holds. PCE inflation is above the Fed's forecasts, and the Fed has a difficult decision to make in 2 weeks' time. Will it raise or skip? The markets are ambivalent about whether the Fed will raise in June, but they are sure that further raises are likely later in the year. All that could change if the data changes. Okay, on to this week's economic data, and I'm afraid there is a lot of it, so I am not going to go through it all. If you want to pause and take a look, please do so. So first of all, in the UK, we had mortgage lending. Now, mortgage lending was really bad, actually. So in April, net mortgage lending was expected to be 0.3 billion, i.e. 300 million. It came in at minus 1.4 billion. So mortgage holders are net repaying debt. Now that destroys money and should be bad for the economy, but the UK economy seems to be resilient. Mortgage approvals, unsurprisingly, also fell and were weak, down from March and well below expectations. Net lending to individuals in April was very poor, only 200 million, well down on March and massively beating expectations. And massively missing expectations. So that all suggests that credit conditions in the UK are declining and net credit creation is falling, which means the credit impulse is negative, and you'd expect to see the UK economy slowing down. Turning to the EU, we had Eurozone inflation numbers, and hurrah! So they were better than expected. So in May, Eurozone CPI was expected at 6.3. It came in at 6.1, well down on April. And core, even better, was expected at 5.5, came in at 5.3, down on April. So in the Eurozone, at least, inflation is coming down. Now, as you see when we go through all the data, energy prices are coming down quickly and food prices are also forecast to come down. So you should see over the coming months, inflation start to ease. Now, we also had the EU economic survey for April, and I've included in red the revisions. So in red is the March numbers we reported previously, and you'll see the revisions are generally negative. So March conditions have been revised down and April conditions are worse. Pause, take a look. But Eurozone unemployment ticked down to 6.5%. And so again, we are seeing sentiment very poor, but actually economic conditions just fine. Turning to China, well, we had industrial profits year on year in April, and they were absolutely shocking, down 20.6%, below expectations. We then had the NBS PMIs, and they showed that manufacturing doing very badly in May. But overall, the Chinese economy still in expansion territory, but slowing. However, we then had the Caixin manufacturing PMI, and that painted an entirely different picture. Whereas the NBS manufacturing PMI showed that manufacturing in China was weak and below 50, i.e. in contraction territory in May, the Caixin showed that it was strengthening and in expansion territory. We're just going to have to wait and see. Okay, turning to the US. Well, we had durable goods orders for April, and they were good, better than expected, although a lot of that turns out to be defense. If you strip out defense, then durable good orders fell. We also had PCE inflation numbers, and I'm afraid they were strong. Inflationary pressures, according to PCE, which is personal consumption expenditure, and the Fed's preferred measure, that came in month on month at plus 0.4%, much higher than the expected 0.2%, and year on year at 4.4%, up on March and well above expectations. Core also rose to 4.7%. Now, we had consumer confidence numbers from the Conference Board for May. They beat expectations, and also they revised up their April numbers quite substantially. So the US economy appears to be doing just fine currently. However, the Chicago Business Barometer, which gives a measure of business conditions in the Chicago area, collapsed in May to 40.4, well below expectations and well below April numbers. Then we had the JOLTs job openings, and they rose unexpectedly, massively beating expectations. The expectations were for a fall. We have further data on that later. The quits number, however, fell. So fewer Americans are leaving their jobs, and because they are less confident of getting a new one. The Challenger job cuts number rose, but not as much as expectations, and the ADP employment change for May continued to show good jobs creation and was well above expectations, although slightly down on April. And we also had the ISM manufacturing numbers, and they were awful, actually. So headline PMI missed expectations, but new orders collapsed to 42.6. But mystifyingly, employment actually rose. So we have new orders collapsing, but factories adding more staff. It's a mystifying economy at the moment. Prices paid fell sharply, and that is good news. And finally, we had quarterly numbers in the form of unit labor costs in the US, and they were massively below expectations at only 4.2%, up on Q4, but that's good news for inflation. On to some charts, Richard.
Thank you, Keith. UK retail sales month on month. They're choppy, but as we know, not really driving the economy.
Yeah, but up.
Yeah, and retail sales year on year below zero, so a contracting retail economy. UK mortgage lending negative, i.e. more repayment than new mortgages, and that is a sure sign that the housing market is slowing down. UK mortgage approvals continuing to fall. I think that there is a continuing downward trend from around about late 2020.
Surprisingly strong, actually, given the mortgage affordability.
Yeah, I mean, as we said before, these things seem to take quite a long time to work their way through, through into reality, into the real economy, don't they? And UK net lending to individuals. I mean, whether this is banks tightening, probably a combination of banks tightening and people maybe drawing in their homes and deciding they don't want to borrow, particularly as interest rates are so much higher than they.
Yeah.
And basically, you could borrow free money, couldn't you, effectively, a year ago, 2 years ago, and you can't anymore.
Yeah.
EU CPI falling steadily.
Yeah, that looks good now, actually.
It does, yeah. And EU CPI month on month showing no change.
Yeah, that's great.
Yeah.
Annualized inflation as of May, 0.
EU core CPI probably turning down, but
Yeah,
at the beginning of 2022, we had a similar chart pattern there, so we need
yeah,
to give that a little bit more time. EU unemployment rate continuing to fall.
yeah. Tight labor markets everywhere.
Yeah. We have US durable goods orders month on month, which are growing in March and April significantly. And ex-defense, it actually shows that defense has quite a significant contribution, doesn't it? Ex-defense US durable goods orders fell in April.
Yeah, this must be the war in Ukraine. And,
Yeah.
we know the US has been donating a lot of ammunition and equipment to the Ukrainians. So they're having to restock.
Yeah. US personal spending month on month, showing reasonably positive signs there. No sign of recession. US personal income month on month, again, positive.
Yeah.
US PCE inflation month on month. Certainly inflation is not licked yet.
Yeah.
That's a bit spike up. And this is why the Fed is being very nervous about interest rates, because there's some data that says inflation is falling, there's other data that says inflation isn't falling. And they're
I agree.
hawkish because they want to keep it under control. They don't want to lose this fight. US PCE inflation year on year looks like it's still in its steady downtrend. And US core PCE inflation month on month. Again, it's looking rather intransigent, isn't it?
It is, yes.
0.4% month on month must equate to around about 5% year on year.
Yeah. And really, that does not look like a steady downward trend.
It's not, is it? No, it's more looking like a plateau. US Michigan consumer sentiment. Note this is a noisy chart.
Yeah.
And if you draw a channel down from 100 to where it is now, it's still in that down trending channel. And as is the current conditions. So it could well go lower yet. The 1 year inflation expectations, remember last week we had that big, or last time we had that big spike up, didn't we? Now it is in a suggesting that it's continuing to fall. And the 5 year inflation expectation has gone up.
Yeah.
So people are less positive about longer-term inflation levels. The US Dallas Fed manufacturing index is really sick.
Yeah. And I just don't understand why they're adding jobs. Amazing.
No, I agree. Of course, we don't know how many of those added jobs are public sector, do we? US Chicago Business Barometer, likewise looking pretty unhealthy. US construction spending month on month, on the contrary, looking very healthy.
Looking very amazing. Amazing.
Yeah. And US ISM manufacturing PMI on its steady downtrend. And US ISM manufacturing new orders likewise on the steady downtrend.
Yeah. New lows.
Yeah. The US PMI minus customer inventories is continuing to fall. If it falls much further, it will be distinctly into recessionary territory.
Yeah, it's pretty much there already, frankly.
Yeah. US ISM manufacturing employment, basically oscillating around the 50 level.
Yeah. But new orders and the PMIs are collapsing. Why are they adding staff? Doesn't make any sense.
No, but again, I wonder whether there's a public sector influence there. I don't know the answer to that question. US ISM manufacturing prices paid. That is in a really quite a strong downtrend by the look of things.
Yeah, that's good news for inflation.
Yeah. And US JOLTs job openings, it's sort of like at the moment it's just in a range between 1 million and 1.2 million.
Yeah, very strong.
The quits rate continuing to fall, definitely in the downtrend. and it's returning to normal. In other words, confidence. I mean, it's returning to normal, but it would suggest that confidence is seeping away. And also suggests maybe that it's not just a question of confidence, it's that actually the jobs that people would move to aren't there.
Yeah. And presumably they're not paying substantially more than their current job.
Yeah. The US challenge job cuts, they rose quite sharply a few months ago, and they've sort of stabilized at that slightly higher level. But they're not showing signs of increasing yet.
Yeah. If you look at the highlighted line for May, you'll see that artificial intelligence was cited as a cause of 3,900 challenger job cuts in the US in May. And that is the first time that AI has been cited as a cause of job cuts. And frankly, that number is only going to rise. So we're seeing the first signs of disruption caused by AI. The other thing is the bankruptcy line is astonishingly low, given we know that bankruptcy is rising in the US. I do wonder whether, if a company goes bust, do they have to do a job cut announcement? Presumably they don't. They just say, we've gone bust.
That's right, they don't. I'd be interested to know the sectors this AI loss of jobs is occurring, actually.
Yeah.
Not just the sectors, but the roles, the job roles.
Actually, a brief digression. So there was something on Twitter today talking about how they had done a simulation, the US military had done a simulation where they had trained some software which was meant to be in charge of US drones to take out US SAM sites. Okay, so the AI would get points for blowing up SAM sites, but it would have an override by a human operator. And so the human operator started to veto some of it blowing up these SAM sites. So the AI worked out that the human operator was causing it to lose points and decided to target the human operator.
That's very clever, actually, isn't it?
Yes.
Because basically it was given very simple. It was given a simple command: maximize your point score.
Yeah.
That's the best way of doing it. Now, what you may not realize, Keith, is that I am in fact an avatar, and all of my comments are being generated by AI. Today, it's the first time I've tried it.
Right.
So I'm sitting in the garden having a coffee.
Well, I think you should, on the visuals, Richard, I think you should get them to, add some youth or something, because the AI is,
it's looking a bit ancient.
It's looking a bit ancient.
Hey, I'll have a word with you afterwards.
Moving swiftly on.
US ADP employment change. The problem with this chart is that the COVID spike downwards has sort of has changed the scale such that the information in the rest of it is really quite limited.
Yeah, but actually, when you look over the last year, employment change.
Yeah, positive. Quite right.
Yeah.
Headline ADP numbers disguise the fact there have been job losses for high-paid white-collar workers, strong job growth for low-paid workers. Always the problem with headline numbers, isn't it? It's what's in the detail.
No, I thought this was really interesting.
Yeah, that's quite interesting, isn't it? Because obviously the high-paying jobs are really what drive the economy.
Yeah.
And total withheld employment income taxes in the US are down year on year because of those white-collar job losses and also falling hours of work, which of course is not good for the US deficit either, but indicates that the total wealth being generated by employment is falling.
Yeah. So the headlines, so I've mislabeled this in that growth is down year on year, but it is still growing, but at a very low rate, 1.5%.
Manufacturing shedding jobs and construction still adding them. And we saw, didn't we, that construction was increased last month. So I think it's fair to say, don't understand why construction is so strong.
Yeah.
We can't understand why manufacturing is shedding jobs.
Yeah, and this contradicts the PMIs. The PMIs said that, they were adding jobs. Well, this makes much more sense, frankly.
Yeah. US initial jobless claims on a bit of a downtrend now. This is weekly data.
Mm.
And US continuing jobless claims pretty much plateauing at that level.
Yep.
Really changed for 2-3 months.
However, let me take this, Richard. So the thing is that we know that COVID caused enormous fluctuations in the employment market and continuous claims. And that has affected the seasonal adjustments. Now, pause, take a look. Basically, if you look top right and assume constant continuing claims going forward, well, because of the seasonal adjustment, it will look like continuing claims are falling over the coming months. And so bear that in mind when looking at the headline numbers, because we are seeing in the headline numbers initial claims stable or falling slightly. Well, actually that may just be due to seasonal adjustments.
And so we have the US NBA 30-year mortgage rate, which is climbing back up very close to 7% now. This has got to be affecting the prices of new homes. And the mortgage market index basically is looking pretty unwell.
Mm.
Red book retail sales just continuing its gentle decline. China manufacturing PMI. I think China is slowing down. I don't really understand this data. And China non-manufacturing PMI, the spikes down are due to those extended lockdowns, aren't they?
Mm.
Bounce right up, and now it looks like it's falling back. And that's along with the profitability data. It doesn't show a particularly strong economy, but of course that profitability data you referred to, Keith, also includes periods of lockdown, doesn't it?
It does, yeah.
And China general PMI, it's showing growth after those lockdowns.
Yeah.
Need a few more months data to see where we really are. The Chinese manufacturing PMI is positive.
Yeah, well, the Caixin number contradicts the NBS number. Who knows?
Yeah. So in summary, we've got Eurozone CPI inflation is below expectations, but still 6.1%, which is jolly high. Both headline and core US PCE inflation rose in April, which is making the Fed really jumpy. Of course, Jerome Powell has staked his reputation on reducing inflation, a la Paul Volcker. US JOLTs openings and ADP employment data show the US labour market remains tight, which is not what you'd expect in a recession or as we approach a recession. And US ISM manufacturing data, it shows a sharp drop in new orders in May, despite which employment is rising. And we have had several months now where we've reported quite contradictory data.
Mm.
And it doesn't seem to be resolving in any particular direction yet, does it?
No.
And then we've got EU services and manufacturing sentiment weakening further in April.
Yeah. The Eurozone economy does look like it's weakening.
It does, doesn't it? Yeah.
US, not yet. Okay, onto one chart. Thank you, Richard. Well, okay, so I thought this was really interesting by Florian Kronawitter. So we have been reporting for a while now that manufacturing new orders have been falling as companies work through inventory. Now, his point is eventually destocking will finish and companies will reach the level of inventory they require and then begin restocking, which will then lead to higher manufacturing orders. Now, and so he posted this chart of the US clothing retailer Abercrombie, and you'll see that there's been a sharp drop in inventories. So how much of the destocking has already occurred? And if the US economy continues to hold steady and not go into contraction, there's the possibility of a soft landing as manufacturing orders then begin to pick up. Now, I continue to believe that monetary policy matters and that we have a strongly negative credit impulse and monetary policy works through with a lag. And we have yet to account for the fall in financial asset valuations because of higher interest rates. And we know that commercial real estate in the US will need to be revalued. All that has to come through yet. So, go on.
I would also make a couple of points on this. One is that Abercrombie, being a clothing retailer, will probably import much of its product, so it's irrelevant. That restocking, destocking is not really relevant for the US economy.
Yeah.
Then what is their normal level of stock? This chart only goes back to Q1 2022. And my criticism of this type of chart is that it is such a small, such a simplistic analysis that it's almost modern technology enabled one to do these analyses, but they don't really mean anything. And I would say that this is pointless.
Yeah. Well, it's clearly only one company, Richard, but I take his point that destocking eventually has to end. Now, but previously we showed a chart of new orders minus inventories, and that was hitting new lows. So, it doesn't suggest we are at the end of the destocking process, and inventories presumably are more than adequate. Otherwise, new orders would be picking up.
Yeah.
Okay, and on to financial crisis watch.
So I think the first thing to say is financial crisis, what crisis? Because it has all calmed down. And I would say it's calmed down, but it's not over. Because the conditions that created the problems with the US regional banking system are still, in fact, not only are they persistent, but I would suggest they're going to get worse. And those conditions are still pertinent in the UK and Europe, Australia and New Zealand. And there will be inevitably significant fallout from the rapid rises in interest rates. So, but things have calmed down for a while. So this is the regional bank ETF, which is basically settled down for a bit. Bank deposit data shows that bank people possibly selling, I don't know, maybe selling their I mean, you've got to be really careful with this data because it says bank deposits weekly change, and clearly the idea is you take your money out of the bank account and you buy some sort of bond, and then depending where you buy your bond from, that's going to go into a bank account.
Yeah.
And if that bank account is included in the bank deposits, in fact, there's no change with you switching out of. So it really depends. Again, this is sort of quite a simple analysis, and unless you understand where the money is genuinely going, it's hard to tell. The useful thing would be actually what's the weekly change in regional bank deposits.
Yeah, that's true. But that's money supply growth.
Yeah. Loans and leases, weekly data, just basically following the trend that it's roughly been on for the last 3 years.
Well, actually, I think that number's weak. So, what we're looking at is net change in loans, and recently it's poor. And so the credit impulse is going to be negative.
Yeah, but it has risen now. So if you take, it's about 7 or something, looking probably 10, 12 maybe time. Now, that point of 12 occurs quite regularly if you cast your eye back to 2021.
Yeah.
So, I mean, whether it's going to continue the sharp spike down, whether that's going to continue, I think remains to be seen clearly. And I think it won't.
Yeah.
Because it's too expensive. Automobile loans not looking healthy. And I think there's a lot of stress in the auto loan market in the US. Commercial industrial loans not looking healthy.
Yeah, that's now 3 months of negative loan growth. And
the trend is emerging, isn't it?
Yeah. Consumer
loans, again, we do have a trend. It's a long, slow trend. But we do have a trend there of reduction in the increase in consumer debt. Real estate loans, that chart speaks for itself. Yeah.
But again, we saw a big rise in construction employment, in May.
So again, construction employment presumably includes infrastructure projects.
Yeah.
And we know that Biden has been spending a lot of money on infrastructure. Maybe it's that that's causing the increase in employment in infrastructure, in construction. So credit conditions for small firms are tightening, and they're not far off being as tight as they were in the GFC. Credit conditions for credit cards have tightened very rapidly as well. Credit conditions for auto loans have tightened very rapidly. Rising credit card delinquency rates are a sure sign of an ailing economy, and they're rising quite fast. They're also a sign, as we say here, that lenders will be tightening the requirements. Yeah. This all points down to a slowdown in the consumer sector. And we would expect credit spreads to start widening as companies find it difficult to refinance their debts. And that gap is remarkably large, isn't it, at the moment?
It is, but if you look previously, there is a lag, between tightening lending standards and credit spreads. Yeah.
So this discount window, which I remember when it spiked in it was Christmas time, wasn't it? Was it Christmas 2019, just pre-COVID? And everybody was saying, this is the end of the world, something dreadful's happening in the banking system. And now look at it, it's 3 times the size of that spike. Yeah, and going back to your earlier point, Richard, about the crisis being quiescent but ticking away in the background, this is direct evidence of that. Banks are stressed and they're having to borrow from the Fed, and that money is expensive. Yeah, and they're not lending to each other. Yeah. Which is why they're having to borrow from the Fed. Also, by borrowing from the Fed, effectively, this is a form of QE. It's so large. There's 150 billion of QE that has gone into the system in the last not a couple of months. Yeah, and all the commentary is that's what's been causing the rise in equity prices. Yeah. So US financial conditions are actually not particularly tight, because whilst the Fed is doing its best to tighten interest rates, the government is doing its best to spend money. True. And they're working against each other. So mortgage-backed securities yields premium. So this is saying, credit prime mortgage, that people are taking a 1.8% risk premium for investing in mortgage-backed securities. Exactly. Getting treasuries. Yeah. That is about, that's about 30% risk premium, isn't it? On current interest rates. Yeah. Which is quite chunky. Yeah. So this means it's more and more expensive to take out a mortgage in the US. Okay, so here we have on the left deposit growth year on year, and you'll see deposit growth
in 2023 is negative compared to the median, and in particular 2022. And on the right, you've got cumulative loan growth. Now, cumulative loan growth is positive, but it's below median and well down on 2022. And that means the credit impulse is deeply negative. And this is commercial and industrial loans, and that is pretty terrible, frankly. You know, you have a huge negative credit impulse. Consumer loan growth, again, negative credit impulse, but actually better than median. Surprising.
The commercial industrial looks as if it's going to tip negative, doesn't it?
This is really surprising. Real estate investment actually above median, despite the rate rises, although well down on 2022.
So as you say, that commercial real estate faces a reckoning as the year develops because of office vacancy rates, and the vacancy rates across all of these cities have risen dramatically. San Francisco is the worst, isn't it? Where it's gone from about 8% to 32%-ish, which is an enormous change. This is going to hit commercial real estate companies, REITs, and so forth. Very hard. The other noticeable thing about these cases, they're not turning down.
No, absolutely. I mean, some of these trends, like Seattle, that looks really bad,
isn't it? Just so the banking system in the US seems to have stabilized for the time being, at any rate. We've got tight credit conditions. We've got a strongly negative credit impulse, which is associated with recessions. And we still think a recession is likely in the second half. And actually, my personal sense is that I suspect that things are going to deteriorate quite rapidly at some point.
Yeah, no, they normally do. It's
not clear when that point's going to be.
Yeah, completely. Okay, quickly onto R star. Now, we talked about R star last week. If you missed that, please go back and have a look. R star is the real Fed funds rate that equilibrates the economy in the long term. So it's the point, it's the interest rate that is neither contractionary nor expansionary. Now, this chart on the left shows R star, so current US interest rates versus R star. And you'll see that interest rates during the pandemic were like -4%, like really, really expansionary. And the current rate is contractionary, but not necessarily by that much, by between like 0.8 and 1.5% above R star. So it's not really surprising that the US economy is taking quite a long time to slow down. The bottom line is interest rates have risen very quickly, but from extraordinarily low levels, and are now mildly contractionary.
And it suggests, doesn't it, the Fed is likely to increase interest rates at least a couple of more times this year.
Yeah, certainly if they're not having an effect. And the bottom line is, we've seen for the employment numbers, they're not really having an effect yet. Although, of course, monetary policy acts with long and variable lags. And on to inflation watch. Well, only had numbers for the EU last week, which we reported earlier, but they were reassuring. So May CPI, and these are the flash estimates, came down to 6.3%, and the core came down to 5.3%. Steady progress. Now, goods inflation is continuing to decline, and based on input and output prices, it looks like manufacturing prices should continue to fall, and hopefully we have the prospect of deflation in goods later this year. And Eurozone companies' selling price expectations have collapsed, and that leads CPI. And we know the Chinese economy is not doing very well. And traditionally, one of the ways they stimulate the economy is through exports. And that should mean they export cheap goods and deflation. But in the US, core PCE inflation is proving persistent. The brown line is the target, the dark blue line is trend, and frankly, it ain't coming down. But if you exclude financial services from core CPI, then you get a more reassuring picture, because presumably financial services prices are a function of interest rates. So, as interest rates have risen, so the cost of financial services has also risen.
Yeah, but that's a bit spurious, isn't it? Because we experience that cost.
No, that's true. But, you don't want to you raise interest rates to fight inflation. And if inflation's rising because of, you're raising interest rates, you have this feedback loop which confuses the overall picture, and you want to try and exclude it.
Yeah, that's true. Yeah.
And some contradictory data coming up. So we've talked earlier about how PCE inflation is persistent. Well, if you annualize more recent CPI inflation, you get more reassuring numbers. CPI less shelter is annualizing at about 1.2%. That's great. Now, wage inflation does appear to be slowing, although it's currently 3.8%, and that's getting back towards normal levels. So that's good news. Grocery inflation in the US, JP Morgan are forecasting it is going to fall rapidly. Now, hopefully, that should eventually come to the UK. Used car prices in the US are falling again, and we have seen that consumer auto loans are in decline, and that should reduce car demand. Now, in Europe, Spanish inflation is really collapsing down to 3.2%, and there has been discussion on Twitter about how Spanish inflation leads the rest of Europe. Well, that's good news, although if you look at core, not so good. Core is coming down, but not as quickly. It's the same everywhere. German inflation fell more than expected, 6.1%. That's good news as well. And very good news, food price inflation in Germany fell sharply in May. Now, hopefully that will come to the UK in due course. But the latest British Retail Consortium data is not very reassuring. It's saying UK shop price inflation rose in May up to 9% year on year from 8.8% in April. Non-food inflation was up to 5.8%. Food price inflation eased only slightly to 15.4%. Now, I fail to see why German food price inflation, which has been higher than UK food price inflation, has come down sharply, but UK food price inflation hasn't yet.
It's very strange, isn't it? Because basically we must use the same markets, and the exchange rate euro is actually pretty constant at the moment. So it does beg the question of maybe there's a difference in the way they calculate the data.
Well, just on my brief visits to the supermarket, I know that seasonal goods such as cucumbers, the prices come down sharply.
Yeah.
So this is the BRC data, and you'll say, is that the beginning of a trend? I really hope so. Now, Trueflation use data from the internet, and so live reported prices, and their food price data for the UK is much more reassuring. So they're showing actually a steady decline now in food price inflation. Now that spike there was the last day of April. And so in May, food prices are coming down.
From personal experience, I'm not entirely convinced by that. So I can't remember if I mentioned this before. If I did, apologies. But tins of tuna from Sainsbury's are 1/3 smaller now than they were a month ago.
Yeah. Well, that may well have been that spike, Richard.
That's a 30% spike.
Well, that's the increase. Yeah. Well, it's not.
And Anchor and Lurpak butter packs have been reduced from 250 to 200 grams.
Really?
Yeah, that's a 20% spike.
Yeah.
So I'm sure that these people, they account for the pack size.
They do. Yeah.
So, but
They do. Yeah.
Yeah. But anyway, we'll see what we've got. I'm a bit dubious.
Well, I think no, food prices should come back down because food prices. So thank you to Hugh, our farmer viewer, who was talking about his fertilizer prices on the feedback to the YouTube channel. And he was saying that, prices are coming down for farm input.
Yeah.
And that should eventually lead to, with a lag, falling food prices in the UK. Touch wood.
Fingers crossed, definitely.
Yeah. US trueflation, right down to 2.9%. UK trueflation, actually down a lot in May, but still 13.3%. Not much fun. Okay, so in summary, inflation is coming down, but it's coming down in the US. It's coming down slowly. It's still well above target everywhere, but it should fall further in coming months because we know energy prices are well down on last year and food prices are coming down. And quickly onto US student debt repayments. Now, this is in the debt ceiling bill. So currently, US student debt repayments have been paused, but they will resume on the 30th of August, according to the text of the debt ceiling bill. And that will mean that anyone with student debts in the US will have to start repaying them, and that will have a small but negative effect on US consumption, as those repayments all come out of post-tax income and directly reduce discretionary spending. Now, the median student in the US owes $333 a month, although some of the people who've got professional and doctoral student bills, those are big numbers. And so they estimate that student loan repayments will boost tax revenues by about $5 billion or $60 billion a year, which is about 1.2% of total tax revenues. So marginal, but that will reduce consumer spending in the coming months. On to Recession Watch, Richard.
Thank you, Keith. So is the US already in recession? According to gross domestic income, it is. And it has been for a little while. So the gross domestic income, measure of incomes earned and costs incurred in production of domestic products. So it's a sort of alternative gross domestic measure to gross domestic product. So these are quarterly numbers, and so for the last 2 quarters, it's showing significant negative growth, which means on that basis, the US is in recession. Yes, and the commentary is that GDI historically has been more accurate estimate of economic activity than GDP, although frankly, the bears would say that. Yes. UK retail sales are showing the impact of inflation on consumption. So the value has gone up, the volume's gone down. and the difference is the price increase.
Yeah.
So we're buying less stuff for more money.
Yeah.
Like butter. 1.4 million households will be refinancing their fixed rate mortgages this year. And most of those fixed rates will have been set at a rate below 2%, and they will be refinancing at probably around 5%. I don't know exactly what.
Yeah.
And that's going to make a massive difference to disposable income of 1.4 million households.
Yeah, that's right. And so we've talked previously about how monetary policy works with long and variable lags. Well, this is one of the reasons for the lags.
It's also clearly going to make a difference, is making a difference to the affordability of houses. Because the mortgage repayments are so much greater because interest rates are higher. That must result in a reduction of average prices in the housing market.
Yeah, but frankly, we reported the data earlier, but we didn't discuss it. The UK housing prices have turned down, but only by about 3% year on year. I mean, really very low.
Minute, isn't it, in comparison to where they have come from?
Yeah.
I would expect to see some pretty large reductions over the course of the next 12 months or so. So this is the ASDA income tracker, which we show you from time to time. And the good news is that in the year to April, UK disposable income rose year on year. And that is that the base effects of last year's surge in energy prices, which occurred in February, really, didn't I think, when Russia invaded Ukraine, February, March, let's say, have dropped out. Yeah.
Well, frankly, Richard, one of the things that I've got completely wrong, but I'm still mystified by, was that I was forecasting the UK would go into recession by early this year, in part because we're forecasting correctly that there'd be around a 15% drop in UK disposable income, which occurred.
Yes.
So I still don't understand how the UK economy has done okay when disposable income dropped by huge amounts due to the rising energy and food bills.
Yeah, I mean, I agree with you, Keith. There's clearly a big lagging effect here. I guess there's a combination of factors must have sustained the income levels, including, I don't know, have we seen recently the credit card data for UK?
No, haven't actually. Yeah.
UK new car registrations showing healthy growth. And the interesting about this is that a lot of new car registrations are funded by what is effectively debt.
Yeah, absolutely. Mystifying.
Yeah, with large balloon payments at the end. Or you roll them over. So
one thing I didn't know is a mild hybrid EV is basically an internal combustion engine with a bigger battery. So that allows you to essentially turn off the ignition automatically whenever you stop.
Oh, to restart.
Yeah.
So the interesting here, Keith, look at the way diesel vehicles have just dropped off. 56,000 petrol, 5,000 diesel. I remember the time when Gordon Brown, I won't say anything more about Gordon Brown other than this, was promoting diesel cars because they were supposedly better for the environment. Of course, that was complete bollocks.
Yeah.
He just didn't understand the chemistry of diesel cars.
Well, to be fair to him, he was probably misled by the industry. They're all reporting NOx levels much lower than they actually were.
I don't think that Gordon Brown was fair to us. I've seen it to him.
Well, I wish he hadn't sold the gold.
Absolutely, the brown bottom, as it is known.
Yeah.
To our continuing shame.
But if you look at in aggregate, these numbers are really amazing. So 20,500 battery electric vehicles, up 60% year on year.
Yeah.
Conversion to electric vehicles is happening.
It is indeed, and I mean, to be fair, when my car finally bites the dust, my aim is to keep it for as long as I possibly can. It's a petrol car. I will buy an electric vehicle. There's no question of it.
Yeah.
So US new car sales grew up 13.1% year on year. And that is, that's a chunky number given what's happening with interest rates.
Yeah. Again, mystifying. Now, we know that interest rates are higher. Most of the cars are sold on credit, so that increases their cost. We also know that car prices have shot up over the course of the year, and also the banks are tightening lending standards for auto loans. And yet, car sales going up year on year. How does that work?
It doesn't compute, does it? A lot of stuff doesn't compute at the moment.
Yeah.
As we keep saying. German manufacturing PMIs continue to weaken.
Yeah.
Quite dramatically, really. Global chemicals capacity utilization has dropped from pre-COVID levels of nearly 80% to sort of 67%.
Yeah. And chemicals used in absolutely everything. And this suggests a weak global economy.
It does, doesn't it? Or people aren't painting things.
We talked previously about last month about how the Bureau of Labor Statistics in the US produces an estimate for net payrolls and then non-farm payrolls. And then as more data comes in, they revise it. And if you look at the revisions, they're actually a very good leading indicator. So you see that negative revisions to previous data tends to occur when the economy is slowing down, and they tend to revise upwards previous numbers when the economy is expanding. And so we're now seeing the economy in the US would appear to be slowing on the basis of payroll revisions.
Yeah, and once that goes negative, we pretty much enter the recession at that point, don't we?
Yeah.
So basically, on that basis, we could be very, very close to recession on GDP as opposed to GDP.
Yeah. Yeah. Well, we'll see. You know, we've been forecasting recession for quite a long time now. Although, to be fair to us, we've always been forecasting it in the H2, and we're not yet in H2.
When we finally get a recession, Keith, we should open a bottle of champagne as a celebration that we got it right.
Yes, exactly. Yeah.
So US bankruptcies. Now this is a contradictory piece of data, isn't it? Here we have US bankruptcies rising, but the cause of unemployment data that we showed much earlier showed that bankruptcies have virtually no impact on unemployment.
Yeah. Well, those are challenger job cuts and those reported job cuts. So perhaps if you go bust, you don't actually,
You don't, yeah, quite right. Yeah. And Deutsche Bank forecasting a rise in high yield bond defaults. I don't think you need to be Deutsche Bank to forecast that, do you? It's not likely not to happen. Excuse the double negative. But
yeah.
Rates are going up, defaults are likely to increase.
Yeah, but the thing is, the credit yields have hardly risen. We saw the Goldman Sachs Financial Conditions Index earlier. You know, it's remains quite loose. People are not charging huge premiums to lend to high yield companies.
Indeed, yes, that's right, Keith. Permanent job losses positive. It means the number of permanent job losses is going up.
Yes.
Unemployment is going up.
Mm.
Well, permanent job loss going up. So as opposed to temporary work.
Yes, exactly.
So this is a chart showing US house completions expected to fall slightly in 2023. Yeah, I mean, again, we were thinking US house completions would fall sharply towards the end of 2022.
Yeah. Well, we saw from the ADP numbers, strong jobs creation in construction industry.
Yeah. RVs, recreational vehicles. RV sales are down 45% year on year. Mind you, they had the most enormous COVID spike.
Yes, that's true. That is absolutely true. But traditionally, RV sales have been a good predictor of consumer spending because they are a huge durable good and discretionary item.
I don't know what a part model is.
Part models are basically, they don't go on the road. Yeah, you stick them in a whatever
Fixed caravan.
Fixed caravan. Yeah. So high housing costs rising.
Trailer park.
Yes, exactly.
With you, yeah. So the National Association of Credit Managers are reporting steadily rising bankruptcy in both services and manufacturing.
Yeah. See, I think this numbers are really interesting.
Yeah. And it is quite peaky, isn't it? I mean, it's not at the level of 2020 or 2008 by any means yet.
Yeah. Rising.
Yeah. And the credit managers index is falling again, also part of stress in the lending sector. Citigroup Economic Surprise Index. I mean, the surprising thing about this to me is that anybody's surprised by it.
Well, I'm surprised by it. Frankly, I was expecting it to be deeply negative by now. I suppose people have adjusted their expectations lower is probably the point, Richard, your point.
I think that's quite surprising, Keith.
Yeah.
I mean, clearly, it tells you nothing, does it? I mean, it tells you retrospectively that COVID was a bit of a shock.
Yes.
Which I don't find surprising, actually. But we should have we need the second derivative of the economic surprise index, which would be the surprise value of the economic surprise index. And it would be a straight line.
Yeah. Yeah.
Someone spent all their life preparing that.
Well.
So the Atlanta Fed GDP now estimates remain solidly positive. So we've got 3 quarters there: 2022 quarter 4, 2023 quarter 1, and 2023 quarter 2. And it's around about between 2 and 3%.
Yeah, although I would note that the Atlanta Fed GDP now forecast tends to overestimate GDP growth, and then after the quarter's ended, they revised it down sharply. The 2022 Q4 ends there?
Yeah.
And then, their estimate is revised sharply much later. And we know that, when the quarter ended, they were forecasting actually really strong GDP growth in Q1. And then actually it turned out to be 1.1%. So
it's quite noisy.
Yeah.
That's a surprise, actually. Do you think that maybe it is in the economic surprise index? So China's glass production has been declining. That is interesting.
Yeah.
Because that's a sort of direct input into modern buildings.
Exactly.
And domestic appliance demand is also falling. Which suggests that the consumer discretionary expenditure is under pressure, and obviously construction is under pressure. So credit contracting and bankruptcies rising, sort of generally speaking. The global manufacturing sector has been contracting for many months, particularly the chemical sector. Consumer remains resilient, which surprises us. And recession remains likely.
Yeah. But eventually, tighter credit conditions have to feed through to falling car sales, you would think. Just don't get it.
Yeah.
Okay, quickly on to US housing. Now, last week, I showed you this chart, which suggests, and this is from Florian Kronavitter, that the number of homes per capita in the US is above its peak during the great financial crisis, and therefore the US does not have a housing shortage. Now, thank you to a regular viewer and commentator, C. Peckham, for getting in touch, and he is skeptical of that. And what he points out is if you look at the number of housing starts. Well, basically, after the great financial crisis, there was a collapse, and that meant that there were a lot of houses that should have been built that just didn't get built post GFC. And also, we have no numbers on housing demolitions. And therefore, there's unlikely to be a surplus of housing in the US. And this is entry-level homes constructed in the US. And basically, there just aren't any. You know. Now, if you look at housing starts per person in the US, well, they're well down on historic numbers. Although I would point out that with an aging population, that's not necessarily the best metric, because what new families, new households need new houses. Old people live in their existing houses. But so therefore, I've had a look at housing construction compared to the change in population in the US. And you get a huge spike during COVID because immigration stopped, and therefore population growth halted. But what that does mean is that the rise in housing construction over the last couple of years will have exceeded household formation over that time and should have eased the housing shortage. But household formation in the US will be aided by the fact there are lots more single-person households. Although, if you look at the average number of persons per household, it's actually quite stable, despite the fact there are more single-person households, presumably because adult children can't afford to buy their own house and they've moved back in with the folks. And investors are certainly not propping up the housing market. They have completely pulled in their horns. So in summary, actually, I think this argument is slightly beside the point, because the bottom line is there's certainly unmet demand for housing in the US. If the price is right, people will buy them. And what we've found really surprising is the continuing strength of the US construction market, when we know that the median mortgage payment on the median house is well above normal affordability metrics. So that means that cash buyers must be responsible for buying the houses in the US. And how long can that continue? Eventually, you'd think that will fade. So we continue to predict a slowdown in the US housing market, despite no evidence to support us. And on to solar power, Richard.
So renewable power generation is growing rapidly, and this shows that the new renewable power capacity added in 2023 is going to be very significantly higher than in 2022, and the rate of growth is accelerated, and that's 450 gigawatts of power in 2023. So solar and wind are going to lead the largest annual increase in new renewable capacity in the US ever, with other, which presumably is basically hydroelectric power, trailing a distant third. So an awful lot of solar farms being put in.
So the duck curve shows you electricity demand on the grid. And as you get more solar power coming onto the grid, then it increases the volatility of electricity demand, because you get this surge in the morning as people wake up and turn on the kettle, and that is not met by solar power because solar power is not getting going yet. But then during the day, solar comes online, and houses which have solar power don't need electricity, and they also try and export electricity to the grid, and solar farms come online. So actual solar electricity demand declines. and then it rises again in the evening as people come home from work, and solar declines. So you're increasing the volatility of electricity demand. And so during the day, you have excess solar power, and then you need to bring on your backups in the morning and in the evening, rather than, running them continually between, 5 a.m. and midnight.
So what we see is that the power cost of power in Europe regularly goes negative because of the excessive generation of solar power during the daytime. And of course, this could be addressed by large-scale storage, but large-scale storage is incredibly expensive. And if you see the UK at 2710, we're not going negative, but if we had decent interconnectors or a better interconnector with Europe, we would be able, hopefully, to reduce that cost.
Yeah.
And utilize the European solar power.
You see that Holland has prices of minus 26 euros. And whereas Poland has plus 45. If you could connect the two, everyone wins. And
then we have a rapid increase of electricity prices overnight. The UK is pretty high, isn't it? 82.6.
Yeah.
So, of course, Norway has a lot of hydroelectric power, so I presume that's why it's quite cheap, even at night time. So there's a very big gradient in pricing. We're sort of generating it at the wrong time, aren't we? So, as I say that, it stresses the grid, undermines the economics of power generation, and basically, another factor as I mentioned, it covers vast swathes of ground.
Yeah.
These artificial things, which are hugely carbon intensive to produce, have a limited lifespan and aren't actually particularly efficient at generating solar power from the amount of energy that falls on them, and could easily be replaced by a few high capacity nuclear power stations.
Well, I agree, but I mean, I just don't understand the economics of solar power now, because all these additional solar panels, you will be producing power when the grid prices are negative.
Yeah.
So, I mean, how does that work?
Yes, because you're only ever producing when everyone else is producing, and when everyone else is producing, the price is negative. And you've also got the cost of disposing of these things.
Yeah.
And they reach the end of their life. The whole thing it's a tragedy, really, I think.
Well, I don't understand it. There must be enormous subsidies, because the economics don't work.
No, they don't.
Okay, thank you, Richard. On to other charts. And we have a section basically on China. So these are charts from the FT, and they show that the Chinese economy is losing momentum. So if you look at retail sales, month-on-month change, declining, although still positive. Industrial production in April looks terrible. New housing starts, awful. Unsurprisingly, we've been forecasting a bursting of the Chinese property bubble for many years. Perhaps it is finally happening. This is bad. Youth unemployment rising steadily, and that is a recipe for internal unrest. Lots of young people with nothing to do. Property sales are falling. We have talked previously about how Chinese property prices are just absolutely mind-blowingly ridiculous. And, finally, perhaps the bubble is bursting. If you look at disposable income growth, that's weak. Consumer confidence has recovered from the pandemic lows, but really not by much. But various surveys of consumer sentiment seem to show it improving rapidly. So maybe there's hope. But I think we saw earlier the plate glass production and the amount of property sold. The Chinese economy has been supported by real estate investment for decades now, and it looks like that cycle is coming to an end. So that bodes ill for the Chinese economy. If they turn back to manufacturing and exports, that means they will be exporting deflation. And some good news. Well, this is good news. So this is the Los Plateau in northern China, and left is what it was like in 2007, and right is what a highly curated photo of it is like in 2019. But what they have done is they have regreened it very successfully, and it's now the wettest and greenest it's been in 2 centuries. And I read the summary of a paper talking about the precipitation patterns, and it seems that regreening it has increased precipitation levels. Strangely, most of the additional, well, by definition, most of the additional rainfall has come from outside the area. Now, you would expect increased vegetation to result in more water loss from the soil, but then they're getting all of that back and more. And
it must be increasing the atmospheric humidity, mustn't it, Keith?
Yeah, exactly.
Causing more moisture to precipitate out than is evaporating off.
But that's great news. So
it is. Do you know how they did it?
No, I don't actually. Only that it cost a lot of money. Equity markets, Richard.
Thank you, Keith. So FTSE all share quite weak, quiet year. Stocks Europe quite weak, but busy a year. S&P 500 we've discussed. Basically, it's all tech and nothing else. The Nasdaq obviously is all tech, but it's only a few tech companies, and baffles me really.
Yeah.
The Hang Seng up a little bit. The topics, I mean, people seem to be getting a bit more optimistic about the Japanese economy, don't they? Read the press and so forth. Good week for Bitcoin, and a good week for the pound, which is nice. If you're in favour of a strong pound, which generally speaking, it's not strong, is it? But generally speaking, I like to see the pound stronger rather than weaker. Also makes foreign holidays cheaper.
Yeah.
And reduces inflationary pressures. So what's not to like? And the VIX, just dropping further and further.
Yeah, and I retain my short on the S&P 500, and it's costing me money, but not much money, but still. One thing I've got completely wrong is tech. You expect that rising interest rates will mean the deflating of the tech bubble, but actually the all the furore around AI means that people are rushing back into tech.
Yeah, it does. Although interestingly, I was looking at the AI and robotics ETF this morning, as you do.
Yeah.
The chart of it, and it's not really moved that much.
Really?
It's moved a bit, but it hasn't done anything like Nvidia. So, analysts lag reality. Well, there's a surprise.
Yeah.
So they extrapolate current trends. They do not forecast turning points. No, I mean, yeah, it's basically, well, don't get me started. Keith, would you like to comment?
Well, we know that analysts are forecasting rising earnings throughout the rest of this year, which just doesn't make any sense to me. But, I've been wrong on a hell of a lot this year, Richard. So, who knows?
Well, I think pretty much everyone has, haven't they, Keith?
Yeah.
Most of the time, the majority of stocks underperform the index, but the percentage underperforming currently is at extremes, S&P 500. So as we said earlier, 493 shares in the S&P 500 collectively have gone up 1%.
Yeah.
And this is, yeah, I mean, it's not a sign of a healthy market, is it?
No.
So the S&P 500 energy sector's free cash flow yield continues to soar to a multi-decade high, now 13.4%. So they're offering really good cash flow yields. And here we have the S&P being driven by a small group of stocks, which is a tech stock. And if you weight the S&P by equal weighted, as opposed to cap weighted, which is what it actually is, then the difference is the biggest it's ever been.
Yeah.
So the FANG index is going parabolic again.
This just looks insane.
That's an interesting chart. The Russell top 50 versus the Russell 2000. And the Russell 2000 over 25 years have done very significantly better than the top 50.
Yeah.
But as it says, you have to be patient.
Yeah, we are value investors on this podcast. And frankly, I find valuations in tech just totally insane.
So NVIDIA is now at 208 times earnings. I mean, it is hard to see how you're ever going to get a positive return from investing in NVIDIA unless you sell it to someone else at a higher price.
Yeah.
If you held it for the long term, how long would you have to hold it for before you got a positive return?
Well, because the thing is, it assumes that there's no competition.
Yeah.
You know, yeah, they have decent barriers to entry, but, you know, when they're making this much money, every other chip designer is going to be trying to bring out their own.
And they are, aren't they? Yeah, I mean, but it's the mania, isn't it? Semiconductor equipment sales suggest that tech stock earnings are likely to suffer in the coming months because semiconductor equipment sales are falling quite fast.
Yeah.
And all these semiconductor stocks, well, not all of them, a lot of them are on very high valuations. I guess if you drop down to about 20, anything below 20 is sort of possibly okay, depending on what they do. Yeah.
I mean, you'll notice that here you've got NVIDIA on 50 times PE rather than 200. It depends whether it's, you know, forecast or historic, etc., etc.
Yeah. Google searches, AI.
Yeah.
And US consumer spending declined from its peak, so retail stocks have fallen sharply. God, that is a big fall, isn't it? 44%.
It is, but you'll notice they're still much higher than they were.
Yeah. And they've got another 15 to 20, another 20% to go. They maybe more.
Yeah.
To get back to their mean.
I know. You know, when you talk about the efficiency of the stock market, you know, efficient markets hypothesis. I mean, retail stocks going through the roof during the pandemic. I mean, that was never sustainable. So, I mean, the fact that they quadrupled was just frankly idiotic.
Yeah, it was indeed. So, this is the Transport Safety Agency, is that what they are?
I don't know. Yeah.
Travel numbers, 7-day from January 2020, showing that we have recovered all of the COVID, all and more to pre-COVID levels.
Yeah. So I don't know what TSA stands for, but it's the number of passengers going through US airports, basically. Yeah. And you'll see new highs. On to commodities and energy commodities. Thank you, Richard. Well, this is the aggregate index of commodities, and you'll see it's been in steady decline over the last 6 months. So the demand for the demand for commodities has been falling. And energy commodities generally had a poor week. So Brent was very volatile, having bounced 3 or 4% yesterday, but of course the week was down 0.8%, WTI similar. Great news in Europe, where natural gas futures continue to decline, down another 8% in Europe this week. UK gas futures down 7%, both of them down 70% this year. Fantastic for inflation. US natural gas futures also fell back towards their lows, down 50% on the year. Coal had an absolutely shocking week, down 19%, down 67% year to date. Bucking the trend, uranium up 1.9% on the week, up 12% year to date.
Uranium seems to have come back to life after a rather dull period.
Yeah. Some numbers specific to the oil market. Well, we had a big build in US inventories last week. 8.8 million barrels if you exclude releases from the SPR. So that suggests the US oil market is well supplied. Crude production fell to 12.2 million barrels. The Baker Hughes rig count continues to fall and is now falling sharply. And in due course, that will mean lower oil production in the US. So this is crude, no signs of a bounce. Now, China, there are signs that Chinese oil demand is weakening. So this is Chinese onshore oil inventories, and they've been rising. And if you look at February Chinese oil demand, it actually fell slightly, although year on year, obviously because of the pandemic, it's shown very strong growth. In the US, gasoline demand is between 3 and 12% below its pre-COVID levels. So is that electric vehicles having an impact? When I was very impressed by the proportion of new UK car sales which were electric vehicle.
Exactly, yeah.
But one of the reasons that oil has been so weak is that Russia is just exporting everything it can, and this is Russian oil exports.
That's extraordinary, isn't it, considering all of the sanctions that are in place. I mean, clearly, a lot of countries are totally ignoring the Western sanctions.
Yeah,
So,
India being one.
Yeah.
These are EU natural gas futures. That is one hell of a fall from the spike, and that is getting back towards normal. 20 is about normal. UK, very similar picture. Fantastic for inflation. When those numbers start to feed through into utility bills, which because of the price caps in the UK is not yet, but it's coming. US natural gas futures back down to their lows. And the reason US natural gas prices are so low is because production on the left here has picked up, but demand has not. And I thought this was amazing and frankly insane. So as part of Biden's green energy bill, they have incentivized this startup, which is in Texas, and will make methane from hydrogen and CO2. So we've seen previously that US natural gas prices, Total and a Belgian energy startup will be making this plant to produce synthetic methane, 100 to 200,000 tons, using hydrogen produced from the electrolysis of water using cheap solar power and carbon dioxide that they get from anything that burns, nearby plants that burn anything. Now, I can't see how that is remotely economic.
No.
It just seems insane to me.
It does, doesn't it? I mean, it's Yeah, it's being funded by taxpayers, isn't it?
Yeah.
It's not an economic
Yeah.
viable process, surely.
Elsewhere, Japanese LNG imports are at a 2-decade low. And what we have seen everywhere is that very high energy prices incentivized conservation measures. Now, the Japanese have brought back online various nuclear power stations, and conservation measures mean they've cut their LNG imports. And that, again, should reduce LNG prices, good for Europe.
Yeah.
This is coal, disastrous. Uranium looks pretty good, Richard.
It does, doesn't it? Yeah.
Although, and this is, why I'm not getting carried away with uranium is when you look at US uranium production, low prices cause them to shut all these mines. But, if prices get up to economic levels, they just reopen them. There's no fundamental shortage of uranium.
I think, yeah, I mean, there's it's a tricky one, isn't it? Because a lot of uranium is produced in Russia, and clearly we don't want to depend upon their uranium, and very little, it's energy security. So one presumes that the US and Europe should start using locally mined and concentrated uranium for their nuclear power stations rather than stuff from Russia and China.
Yeah. Industrials, Richard.
Thank you, Keith. Well, a pretty active week in industrial commodities, actually. So aluminium was up 3.2 on the week. Cobalt was down 2.2. Cobalt was nearly halved this year. Copper had a good week and is actually now only down nearly 2% on the year, so pretty much unchanged on the year. Chromium down 1.5%. Notice there's no real consistency with these. And certainly we can't equate it to an expanding Chinese economy. Iron ore up 5% on the week, down 11% on the year. Lithium up an astonishing 31% on the week, still 44% down on the year. Neodymium really pretty much unchanged on the week in the context of the above, but also down nearly 40% on the year. Nickel a good week, but down 30% on the year. Tin actually a good week, up 6.2% and a little bit up on the year. Ferrovanadium not really very much change, but down nearly 13%. And zinc a little bit up, down 22% on the year. But if you cast your eye down the year to date, they're all negative, some very strongly, apart from tin. And the weekly change is mostly positive, and some of them are quite large. So you do wonder if, going back to the chart that Keith showed a little bit earlier of the Bloomberg Commodity Index, whether actually it might be turning around. Time will tell.
Time will tell. On the lithium price, you'll see from the chart that they have revised recent data.
Right.
So that's the reason it's jumped by 30%.
So there's the aluminium chart, cobalt, copper, and copper inventories are very low, and demand for copper is constantly going up with electrification. One of the things that I have an investment in is copper, and I'm going to hang on there for years, I think. Chromium, so iron ore, very volatile, but it looks like it's stabilized roughly around the current price. Lithium, big spike back up. Neodymium, nickel. I mean, a lot of these are really quite specialist elements, aren't they? I think nickel is an interesting one because it is important in battery technology.
And stainless steel.
Stainless steel, yeah, definitely. Tin, ferrovanadium, zinc.
Yeah, You'll notice that this week I have put in 10-year charts to put the prices in long-term perspective.
Precious metals, gold up 1.7% on the week and up 8.4% on the year. Silver, a big up week, but pretty much unchanged on the year. And then platinum, rhodium, and palladium all significantly down, particularly rhodium on the year. And only rhodium had a big move on the week, down 3.6%, which is sort of like industrial catalysts and catalytic converters. So slightly were suggestive of a significantly reduced demand, industrial demand, despite problems in South Africa actually.
Yeah.
So the interesting thing about gold is that although it's been bouncing around a bit, it is still very near its all-time high.
Yeah.
And that is, I think that's an interesting chart going back to 2014 or so. Silver, actually, obviously its all-time high was 50 back in whenever it was, a long time ago. But silver is also looking quite robust at this sort of price level. Platinum is basically pricing itself around about $1,000 per ounce and has done for the last couple of years. Actually, for the last many years, really. Rhodium.
That looks like a huge bubble unwinding.
Yeah, a huge speculative spike, Keith, wasn't it?
Well, so we on the rhodium price chart, we have a couple of companies with exposure to rhodium, and I just thought we'd quickly update you on their share price and how they're doing. And this is Sylvania Platinum, which has come off a bit, but probably not as much as you'd expect. And this is Jubilee, which has come off a lot.
And there we have the price of palladium. Again, speculation, I suspect.
Okay, thank you, Richard. And on to rates. And after the huge rises of the last couple of weeks, UK rates stabilized this week and came down slightly, although they are still massively elevated. And if you look at the UK 20 and 50 year, if the Bank of England has a 2% inflation target, then the bond market is charging huge premiums to that to lend to the UK.
Yeah.
Now, if you look at Europe, then bond prices fell sharply this week, actually much more sharply in the case of Italy than in the UK. So these are December US interest rate expectations. They've come off slightly in the last week, but the market is coming round to believing that US interest rates will be higher for longer. It's the UK 2-year, enormous spike. That's stabilizing. Same with the 10-year, 30-year. These are really, really high levels. No. So we talked previously about how if the Bank of England failed to get inflation under control, then the market would tighten UK financial conditions rather than the Bank of England. And that's exactly what's happened. Investors have been selling UK gilts. Yields are rising. That means everything linked to UK interest rates has also been rising. So that means rising mortgage rates, rising consumer loan rates, etc., even though the UK base rate has not changed. US 10-year down from its recent peak. German 10-year bond yield. The fall in Eurozone inflation will be good. Italian 10-year, big fall. Italian inflation is actually running at 7.1%. Greek, actually looking really good. Any change to your views, Richard?
I would say that I am quite wary of bonds now.
Really?
Yeah, So I don't think the US has solved its debt problems.
Yeah.
And I think that's going to put upward pressure on them. Obviously, the Fed is at some point will stop raising interest rates. And I think the government, US government and the Fed are sort of playing a tug of war, really. And
yeah.
I suspect that that's going to, my concern would be that that would mean that bond prices remain higher for longer.
Yeah.
Apart from that, equities, yeah, I would still say sell. Gold, still buy, and definitely selective buying in industrial commodities. I mean, I wonder whether, I don't know what you think about this, Keith, energy commodities. Do you think we've reached the bottom of the energy cycle yet, or are you waiting for the recession to start to bite?
Waiting for the recession. You just don't know how low they can go. You know, I've been way too early on bonds. Frankly, if I bought energy at these prices, I'd be way too early. So concluding comments. Well, the US jobs market remains tight, and there is little sign of an imminent recession in the economic data. Now, we have non-farm payrolls out later today. Based on the ADP numbers, I expect them to beat once again. Forward leading indicators remain highly negative. Manufacturing PMIs show declining new orders, but employment is continuing to hold up. We are mystified by that. Credit conditions are tightening. EU inflation came in weaker than expected, though well above target. Now, one thing we haven't discussed is that a paper came out this week by Bernanke and Blanchard in which they broke down the causes of US inflation. And they are saying essentially most of the inflation has been caused by two separate supply shocks. So first of all, the pandemic and then the war in Ukraine, leading to higher energy and food prices. And actually, wages are only responsible for a small fraction of the increase in inflation. Now, if they are right, then once this surge in inflation passes through the system, we go back to the state of the economy and inflation that we had pre-pandemic. And I believe that, but frankly, so far, nobody else does. Richard.
Also, just yeah, I mean, they may be right, but Bernanke is not going to say that absurdly low interest rates for an absurdly long period of time have caused the problem. So he's going to be looking for something that justifies his actions. So I would treat it with care. Yeah.
Well, I think certainly ludicrously low monetary policy plus fiscal largesse during the pandemic was absolutely responsible for a huge one-off rise in inflation.
Thank you, Keith. So basically, my portfolio didn't change over the last few weeks, but the FTSE All Share has fallen a bit over the last few weeks, which has given me an improved relative performance to a couple of weeks ago. I didn't buy anything, I didn't sell anything. So just a reminder, I have got precious metal investments and industrial commodity investments. And the industrial commodities are basically to do with the energy transition. And that's all I have. And I haven't, it's been a bit volatile the last few weeks. I haven't seen any reason to change it. And I am just sitting here waiting. So yeah, so I don't have anything exciting to say, I'm afraid. I'm sort of, yeah, I'm very, very boring. I would reiterate that I don't trade. If I try and trade, I always lose money. I learned that lesson a long time ago. And so I just don't do that. So I'm a long-term investor. People say long-term investing is out of fashion now because if you're not nimble and quick, you won't make money in these markets. I sort of don't really agree. And that's where I am. How about you, Keith? How was your week?
I had a slightly better week, but not a great week. I'm having a terrible year because I've got the trade in long bonds entirely wrong. So I'm down 9.4% on the year, which does not make me feel good, frankly. I've got it completely wrong. And I'm now, waiting for inflation to come under control. But the reality is that the Bank of England has lost control of UK inflation. And as a result, bond yields have much higher than, frankly, I could possibly imagine, and that I thought the UK economy could cope with. And it essentially says that investors are charging a huge premium to invest in UK gilts because they don't think that UK long-term inflation is under control. Now, that is all within the remit of the Bank of England. The Bank of England have failed to control inflation. They have a next meeting on the 22nd of June. They can still solve this by raising interest rates if they so choose. Are they going to be brave and raised by 50 basis points, or are they going to be useless and raised by 25? I strongly suspect the latter. No buys, no sells. Okay, so I did the monthly this week where I talked about the best place to hold, best asset allocation currently. I think it's just cash, but don't hold your cash in the bank. Hold it in TR24 or a similar index-linked gilt. So TR24 matures on the 22nd of March 2024, and if you hold it, you will get inflation plus 1% over that period. And given that inflation has been high, that means you will almost certainly beat anything you can get in the bank, and inflation will be tax-free. Now, I also had some comments online on YouTube last week saying that, A, I was rubbish at macro, which, frankly, right now I'm not looking very clever, and please don't give me any grief on that. Nobody is beating me up as much as myself. But also saying that I was wrong to be buying index-linked gilts and index-linked bonds when inflation's coming down. Now, actually, that's wrong. So if you look at the price of the 2068 index-linked gilt, then as inflation has risen, its price has fallen sharply. Now, if you go back 3 years, the price of T68 was at 300. So as inflation has risen, the price of long-dated index-linked gilts collapses. And the reason for that is that index-linked gilts have enormous duration because most of the cash flow comes as a lump sum at the end of the life of the bond. Now, I covered this in the Beginner's Guide to Bonds. If you want further details on that, please watch the Beginner's Guide to Bonds. But index-linked gilts, perversely, you would think they would do well when inflation rises. They do really badly when inflation rises, and they do really well when inflation falls. And as a brief aside, as I'm eating a lot of humble pie at the moment, this is humble pie, which is a pie made from the entrails of deer. So the rich people used to eat the prime cuts. The poor people used to eat the leftovers, and humble pie was what you served the peasants.
Oh, that's where it comes from.
Yep. And so this is a recipe from the 1600s, which I thought was really interesting because although it's meant to have been served to the peasants, there's some really expensive stuff in here if you're a peasant in the 17th century, because anchovies, cloves, cinnamon powder, mace, nutmeg, black pepper, currants, candied oranges. That's really expensive stuff.
It is, isn't it? Presumably that it's actually humble pie, Keith.
Yes. Yeah,
We
it would have been
have-
humble pie. Yeah. Yeah. And actually, it originally would have been numble pie, which became humble pie and then, corrupted to humble pie. Anyway, I should be making some of that. And I'm not having much fun at the moment. Anyway,
children.
Sorry?
Yeah, feed it to your children.
Yeah, well, I'll be eating myself, actually. Okay, thank you all for watching. Please can you press like and subscribe to the channel, and it's goodbye for me, Keith Jordan.
And it's goodbye from me, Richard Peter. Goodbye.
Yeah, well, I messed that up, actually. I should have said goodbye from you, shouldn't I? Anyway, never mind. Next week, we'll return to normal. Okay.
Have a good weekend as well, Keith.
Cheers.
Bye.
Bye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.